Hello everyone, and welcome to our mid-year stock update. I'm Jason Rericha, and today we'll be recapping the first half of 2024, discussing projections for the rest of the year, and emphasizing the importance of a diversified investment strategy. The first half of 2024 has been impressive for the stock market. Major indices like the S&P 500, NASDAQ, and Dow Jones have posted significant gains. The S&P 500, for instance, is up about 14% as of the end of July 30th when we're filming this video. It was encouraging to see a broad rally across most sectors through May. However, that stalled out towards the end of the month as the Fed made it clear we would have fewer than anticipated rate cuts this year. Technology and chip stocks continued the charge, fueled by advancements in AI and cloud computing through the end of June. However, a few weak profit reports from some of the largest tech companies caused a sharp decline in July. This was offset to some degree by a pop in financial stocks. Though the S&P 500 had a great first half of the year, it's crucial not to focus solely on that metric when evaluating your portfolio's performance. The S&P 500 is heavily weighted towards large cap tech stocks to the tune of about 40%, which means it doesn't always reflect the broader market or other sectors that may be performing differently. In fact, the 7 largest companies in the S&P 500 make up 30% of the index and are all technology and chip companies. You may know them as the Magnificent Seven, as they're often referred to. But by only comparing your returns to the S&P 500, you might overlook the benefits of diversification. Different asset classes such as bonds, real estate, or international stocks can provide stability and growth opportunities that aren't captured by the S&P 500 alone. Even within US stocks, diversification of company size matters. We don't need to look any further for an example than the movement we saw in tech stocks that I mentioned earlier. The weak profit reports dragged the sector down 7.5% in the month of July so far, which pulled the S&P down about 0.5%. Meanwhile, small cap and mid cap stocks, which aren't widely represented in the S&P 500, were up 10% and 5% respectively. This was largely due to renewed expectations of a few rate cuts starting as soon as September. Looking at this chart, you can see the broad rally across small, mid, and large companies through May before a stark divergence began on the heels of the Fed's decision to pause rate cuts. This is because small and mid-cap companies tend to be more interest rate sensitive. It's a good sign to see them starting to come closer together, because if we're going to have a sustained rally, we need the whole market to participate. Looking ahead to the rest of 2024, we remain cautiously optimistic. While there are potential risks such as geopolitical tensions, supply chain disruptions, strong corporate earnings, and a Fed rate cut or two could lead to continued market growth. Our recommendation is to stay focused on the things that you can control. Having a diversified portfolio can help ease some of the bumps along the way and make it easier to ignore the near-term noise we expect to experience with the upcoming elections. A long-term, consistent strategy will also increase the predictability of your returns, which is an important part of sound financial planning. Portfolio performance outside of the context of your goals doesn't have much meaning. After all, your goals should be designed to give you a meaningful and fulfilling life. Don't get caught up in the trap of chasing performance, chase your goals instead. Lastly, we can't end this discussion without touching on the elections. Historically, markets tend to be resilient around election periods. Research shows the S&P 500 has averaged gains regardless of the political party in power. The market's performance is really more influenced by economic fundamentals than by election outcomes. So, in summary, while the first half of 2024 has been strong, maintaining a diversified investment strategy is key to managing risk. Focus on the long-term fundamentals and controlling what you can control. But don't forget to buckle up, because it's going to be a wild ride until we get through November. Thanks for watching, and don't forget to like and subscribe for more updates on important financial topics. And as always, healthy plan, wealthy life.